Welcome. This is the new episode of Wall Street Station. Today we're gonna focus on the most crucial elements for macroeconomy. I'm very glad you decided to pop in order to study those cases together. So, as we do know, the history doesn't always repeat, but it often rhymes, as it's one of the justification of it. And today we're gonna study the present in relation to the past. So without any further ado, let's head on to today's presentation, and there will be many charts to digest in order to comprehend what may lay ahead of us and what may materialize in the next months to come. Alright, so a leading economic index right now, even though it's rebounding, as you can find, still in the territory that's right now we can say as it would be the thought-provoking for many of economists. Right now we can find that it may become a world-shattering case for the economy, as those threats about what may come to us may eventually have its reflection in the real case study. So right now we look like being thrown in at the deep end, and what we may just read out of it is that when leading economic index is reversed to that extent, normally we are suffering from a major drawdown for economy. And right now we can say that this may eventually materialize in the next year, maybe not this one, but when we have just reached the bottom. It was just the end of 2022, and it's sometimes the lag of economy related to this leading indicator is up to 18 months. So still 2024 is under question of possible recession. All right, so let me just jump to another thing. So global tightening effects, that's what also worsening the outlook. We can find that we are not only observe the weakness in the US economy, but also in Europe, where this tightening taking place right now. There are many of economies such as Germany and Italy that right now are suffering from this type of a very strict restrictive conditions. And for recession to happen, we can find that after yield curve inversion took place, it usually took us from 6 months to 22, and normally it takes usually it takes 15 to 18 months, and that's the in my view the most accurate figure. Therefore 2024 will be kind of a also the decisive environment where we may meander along with this kind of a worsening and more concerning outlook, as those drawdown on yields on bonds were very outstanding as of late. Right now, let's just have a look at how it has even been oversold. So 1 year change in global median 10-year government real rate, and that's absolutely monstrous. Bonds continue to look oversold after the equally sharpest rise in the global median real yield seen in at least 60 years. And one of the assessment of analysts is the higher it goes, the higher this median goes, the possibly more calamity we may eventually go through in the economy. So it's very alarming to see. Right here you can find a slowdown in credit creation that I just pointed, and that's due to quantitative tightening that is transforming the credit creation, and right now we have inverted these money printing conditions into very restrictive ones, and that's what we may find out as the one of the monetary factors that is pushing the slowdown of the overall economy. And normally that's the also ominous sign that may lead to a recessive territory. In terms of the conditions that the small companies may eventually been faced to, is that right now there is a threat of being popped out more zombie companies. Those companies that are not only unprofitable but also not giving a prospect of better outlook to come. US small caps have hit a 22-year low relative to large caps, and that's what market is evaluating the future of those companies, as we do know that market is the leading power related to what we can see in the economy. So it's another very difficult element to highlight that may cause a ripple effect on many others meanders of our everyday's reality, and that may significantly also contribute to this recessive outlook. In terms of its comparison of stocks in relation to bonds, right now it may feel like we may go through the kind of major inversion in the next months. Therefore, the stocks may eventually have its inverse momentum to bonds that may eventually rebound, and that's what we may see possibly in 2024, as after so many months of sold off bonds, we may eventually get a normalization of the situation, and then the time where the bonds will thrive. But that's normally a recessive one. All right, so we are right now jumping to the findings where we can find that cash is back. Cash is back. So treasury bills now offer a bigger yield than the earnings on stocks. Therefore, that's also another thing that may eventually push those investors into having an interest in those other types of financial assets, the one that haven't been in a spotlight during latest months. So what about the current confidence? Conference Board Consumer Confidence is finding that right now we are in a more like a territory that also bringing a perspective for difficult times ahead. And even though some elements such as CPIs are showcasing the disinflation to some term, and also retail sales are kind of rebounding, the whole study looks like we are still lagging in relation to what was back in since 2014 by 2019. So we have many things to catch up, and that's also important finding. So even though we are right now in the possible brink of a recession, the corporate financing buffer is not that high as it was back during this 2020 times when we had bigger hedge, and right now those stocks and companies are not so prepared for the time to come as they already been depleted out of the very tightened standards. And also after this COVID shock, many structures of the companies haven't rebuilt yet to stave off this possible great slowdown of economy, and that may eventually lead to even more zombie companies. As we do know, those zombie companies are the companies that are unprofitable and also have a real hurdle in survival. So rising interest rates endanger financially struggling businesses, and that's what we can find right here is effective interest rate paid by S&P 500 1,500 firms is greatly mirrored by those smallest companies that may right now have the difficult time ahead, and companies face a refinancing crunch in first half of 2024. That's when those greater headwinds may come to them. All right, so final thoughts and Q&A. If you have any questions, you can pop some burning of them right in the chat. So economic stress signals potential broader slowdown, and that's out of the charge that there are many things that right now highlighting this inevitable recessive territory. How long it may eventually last, it's still a question that is yet to be solved, but I do find that normally a recession is taking from 12 to 18 months, so it may eventually bring us into a new environment of seeking for favor defensive allocations amidst market uncertainty. However, we are still assessing the possible improvement of economy, and therefore we will study the many of economic cases every day. Therefore, if you wanna have and get an updates about what's going on right now, whether we are suffering or gonna suffer from broader slowdown, or maybe that's a just and temporary correction, just consider a subscription of our channel. Thank you very much, and we are seeing each other tomorrow at 8 a.m. ET time. Thank you very much for sticking around.